Welcome everybody. We are still a little bit ahead of time, 2 minutes. Let me give a short intro. First of all, thank you very much for the organizers for allowing us here to speak to you. Thank you for everybody who came. We want to make it exciting, not only me, but also the other 5 panelists that come after. We share how we trade, what we do, and how we give you an edge of participating in the markets within taking money from them, because that's about the name of the game. What I'm going to introduce to you today is called activity-based futures and Forex trading. We have several systems. We decided today to look at something where you can have a specific trading goal from the beginning to the end. We use that in all systems, but here we present something very unique to you where you can focus on markets, specifying a minimum range you want to trade for, within knowing always when you can keep a high probability up that you make money at the end of the day. And what I did is also I give you several examples, but first of all, we're going to start out with an introduction in what such system is requiring. Yeah, so we're coming about to time 59. So let me give you the legal disclaimer. Oops, that sprang a little fast. So first of all here, my name is Thomas Barmann. You had the little introduction for those who just came in. There's a risk in trading, which you need to consider. And so therefore read that well. Don't trade with money you don't have or you can't afford to lose, because it's not easy to do trading. Therefore, we are here today showing you how we can ease your way into the world of trading. So how to make money trading? Very big question. It needs a systematic. And I detailed that systematic here for you in a couple of bullet points. First of all, predictability. So the system you use has to live up to a promise to first of all produce repetitive trade setups, something you can rely on. Yeah, and if you have questions down the road, I have the chat box on the right, so you can put them in there. We'll take it casual here. It's for educational purpose. We surely also make you an offer at the end, but we do education and system sharing with you. Yeah, so repetitive setup, predictability, and I show you a specific number where the predictability of any system should be, and how you as a retail trader can specify if that predictability target is met. Yeah, then high participation rate, because you want to turn your money as often as you can. Yeah, it's an earns turns ratio game here, and so you want to have a system that continuously produces something. Only 2 times a year a signal is most likely not getting you over the hump, because you predict with a predictability, so a probability to win or lose, and so therefore as more often you can trade with such, as higher your potential for a positive outcome is. And now we come to rule-based trading. We want no interpretation, or very little interpretation. We need to have in every trading system, or we recommend to you, clear rule-based trading: entry, exit, stop, or as in the introduction we heard it, we sometimes don't use a stop, we repair the trade. So never stop loss trading was a little bit lengthy, so we shortened that thing into never loss trading. But stops, entries, exits are an imperative. And leverage, what's that? Look, today we're going to focus on futures and Forex. Those are leverage products. You need very little margin basically to make a sound income when you do it right. You have with the margin also the risk that comes along with it, but when you do it right and you do it repetitively with a high predictability on clear-cut rules, then you have an edge. And I want to show you a lot of examples in the aftermath, because I want to draft down here with you how many instances do we need to look at to first, and how shall we get direction out of a trade. Yeah, it's the first thing. Your system has to give you clear-cut rules for direction. Many of the moving average based systems, they give you direction, but how good is it? Like 53%. That's how we measured, because you know, if it was easy, you could just program a robot, would take us 15 minutes and let it trade. But that's not how it works. Yeah. Then also specific time. When you enter a trade, by when do you need to get out? What I show you today in the examples has clear-cut rules: 3 bars or 4 bars, done. Surprise, but either the market pressure is behind a directional move or it's not there. If it's not there, you take your money out of the market. Or today what we use, we don't repair the trade. That's a lengthy process. We'll take a stop. Yeah, we measure everything on clear-cut rules against that. Time, 3 or 4 bars. Direction up or down at clear-cut entries. Yeah, and then stop. We will work with the stop where to place it, because this is where a lot of the retail traders have a problem. There is a very short stop, and what's going to happen? You get stopped all the time. I show you a ratio where in average a stop goes in relation to the reward that you can expect, and with that you can stay in a trade and still have a positive expectation, as long as you can predict direction with a high probability, because you want to put all of that together, the entry, the stop, and the exit, and with that you can have a risk-reward appraisal, giving you an idea if the trade proposal you are taking is feasible, acceptable, risky. When it's risky, what are you going to do? You're not going to take it. Nobody forces you to trade. If the relations between risk and reward are not in your favor, don't take the trade. But you have to have these measurement instruments that tell you direction, time, entry, stop, exit, and then it's an easy calculation to find out if it's good. And that's where systems knowledge comes in. Yeah. So our systems take all information from level 2, real-time data, then have a signal to noise filter at the beginning. What's that? A noise is a random happening, something that does not continue but is there. A signal is a happening that has a high predictability. We don't know 100%, has a high predictability to come to a certain price move to a certain target. The algo then finds out how far the price move shall reach. That's the exit. The entry is when the signal is detected, and the stop considers the the statistical volatility of the price move of the instrument we are looking for or looking at, and then we evaluate this. Sounds complicated, is complicated, but not for you as a user, because at the end of the day, you see here, maybe in small print, you have a buy signal or a sell signal, and you have a target on the chart that helps you to know your ins and out, and then you can build your bridge between your risk and your reward. Yeah, and so here we go at the beginning, 65% predictability. That's what we suggest every system for a retail trader shall live up to. If you are below that, you are in the threshold of danger to not come out of trading with positive results. Because when that predictability is not given, we'll do some calculation examples together, then most likely you'll not produce a profit. And the next will be frequent trading. So you don't want to have only one signal every 4 weeks. That has a 65% predictability because you can wait forever. And I show you today that we have at least 3 signals in a day, because today we gear everything towards day trading of futures and Forex. And with that, we'll know in a certain time frame, and we'll look later on about 10 trading days, there should be 25 to 30 trades in it, yeah, having a little deviation from it. And then with a 65% predictability, we should win more than we lose, and we calculate that together, yeah, on clearly defined entries, exit, stops. The more mechanical your system is, the better you get out of that. The more interpretation you do, the fear factor of trading kicks in. Ambiguity in our brain is translated into fear and leads us to make bad decisions. But if you trade mechanically, you know your entries, your exits to stop, you just have to hold through with those clear mechanics. And so system test. What do we want to do? We recommend to you at least 20 trade situations, yeah, based on clear-cut rules. Count the winners, count the losers, strike a balance, and then you have an idea if your today's system or any system that you're looking at is giving you what you want to have out of that trading. Yeah, and to go further on that, the statistical volatility. I said the stop is important on the statistical volatility of an instrument. So how far away is the stop? I cannot give you specific on every situation, but I give you an average. An average, the predictability is a relation of risk to reward of 1.2. It sounds strange here, because most likely you learned all your life, never take more risk than your reward. And I'm not saying it's always like that, but I say average. What's going to happen if it's worse? If it's 1.5 to 1, don't take the trade. But you need to have a measure of how much wiggle room, how much statistical volatility you need to bring your trade to target, because you want to give the price move the opportunity to come to target. And with that relation and 65% predictability, you're nicely over the hump, and we're going to calculate together where we're going to get. But if you leave a too tight stop, you'll get stopped all the time. That'll not going to work. Yeah, the one instance when you're in, but then imagine on 10 times you have a very tiny little stop and you get 8 times stopped. At trade number 9, you're not going to be the same person again. So it's important to consider that, and out of our statistics, because we measure and detail everything financially, 1.2 to the expected reward, but also your system shall give you an idea how far a price move shall reach, and so with that you can give a relation. Yeah, so how is it calculated now, where the break-even point is? I put that in a little calculation here. So when you see X stands for the probability of the system to produce a gain, and 1.2 times 1 minus the probability of making the gain is then the loss. And when we zero that out, that correlation will come in a quick note that a system needs to have a minimum of a 54.5% predictability if you consider 1.2 times the risk to reward to break even. Everything above it, you're going to make money. Yeah, very simple calculation. That is about eighth grade math, so that's nothing specific here or special. So now when we consider trading costs, that all has to be in your 1.2. We'll say the trading costs, keep them below 10%. Yeah, if you say, hey, I'm a Forex trader, I have no cost, be easy. I'll show you that you have, because the trading costs we specify are the transaction costs made out of slippage. What is slippage? The difference between bid and ask. So you'll have to consider some of that, and depending on what pair you trade, you'll have to consider maybe 2 to 4 pips, yeah, on this one. And oops, then you have round trip costs, like for futures, yeah, $5 round trip average. Yeah, I know I have better ones, but doesn't matter. That's what the average population pays, and the slippage of 1.2. When you add that all up, you have trading costs of $15 to $25, and that means when you trade below a target of $150 to $250, your odds are not in your favor that you come out with money. Yeah, so I hope that teaches you a lesson, because very many new traders that try to trade these leverage instruments for $50 takeouts or take-ins, it's very dangerous, because when you don't consider the slippage and all of that, and imagine $25 of potential slippage cost and commissions in relation to a $50 target, then your trading costs is 50% of what you have as a potential reward. Very dangerous. But so back to point, you have to trade for a meaningful price move. Yeah, that's what I try to lay out here. Yeah, and we're gonna do that in summary. So meaningful is a move of a future, a move of a Forex pair above $150 by our calculations, and we're an algorithmic house. Yeah, just want to share our knowledge, our way of trading here with you. And so what you learned so far: test your system, 20 trades above 65% probability. Consider the statistical volatility in average, not always 1.2. When it's worse than 1.2, don't take the trade. When it's better, what you do, you increase your size. Yeah, so you're smart, because you want to always limit or gauge your maximum risk or your risk, and if you can have a lower risk, then you can leverage your rewards very nicely, how you can trade with that. And price moves above $150. So I hope those are a couple of things that you write down to keep for the future, and we'll give you more details and combine probability and reality with you now. Yeah, so when an average system, like I told you, like MACD based or moving average based, gives you 53% probability for getting the price direction right, a high probability system gives you 65, and a high performing 70. So we're going to look jointly of how trade situations pan out, considering those average probabilities to predict the direction right, and how we then can work with a trade move. And you saw $150 to $250, we set an average, and so we took here in the example $200, average price move. Yeah, if you can't afford to trade for $200, trading might not be a good choice. Yeah, so when we take 1.2 times the reward equals the risk, and we add commissions, we come to the following conclusion. Yeah, so we say here, if a 53% system, if we have 3 trades a day, our reward is 200, and I just took the average risk of 240, 1.2 times. And when you do that, you most likely, after 100 trades, lose $680, not even considering commissions, because the commissions are mixed in the risk part in it. Yeah, but you see, you had no chance to make money. However, if you do that with a 65% predictable system, after 100 trades, you'll produce $4,600. At 70%, you'll produce $6,800. And when you compare all of these, I increased a little here, the percentage rate to come to break even. Yeah, you saw that before, 54.5. So at 55%, you basically, after commissions, you are right here at $200 profit. However, you make 23 times more profit with a 65% system, or 34 times more profit with a 70% system. So that means what I looked here at 33 trading days with 20 trades per month, that is the return. And how does it translate into making money? Yeah, how does it translate into making money? So when you have an average of, let's say, $500 of margin that you need to put in for one contract, yeah, when you have the right broker that supports you on a futures trade, or might be even less on some of the Forex pairs, then you have an edge. But you see my point, probability of prediction, relation of risk to reward to come to target, that gives you an opportunity to have an edge within constantly trading on clear-cut entries, exits, and stops. Today, I want to focus a little bit on futures, and I took some examples for the ES, yeah, holding myself accountable. When I was invited here, then I took back 10 trading days and listed all the individual instances, but first did the rules, yeah, because we are rule-based trading house, so we trade by rules, yeah, like in traffic, you have to have clear-cut rules, else you're gonna run into an accident or into a problem, yeah. We call trade what you see because we put the entries, the exits, and the stops right on the chart, and we'll leave very little or no room for interpretation, because when you follow this, it's either there or not, and it's either acceptable or favorable in the risk reward. And what we then do is we'll note down the rules for you. Yeah, so giving you some rules that we apply day by day for all the trades. We trade on confirmed signals only. What does it mean? The system throws out, go long above 26.44. Yeah, so for example, and then we give it a tick, 26.44, and when it's DES, so it's in a 25-cent increment, so 25 cents up. At that tick, we get into the market. And then we give ourselves a time-based target. You remember on the first chart, we had this time-based. We want to be out at the third bar, except the third bar has the same directional signal, then we take another bar in. Yeah, so very easy. So either out at the predefined exit, or you are out at bar 3, except it has another signal, then you're out at bar 4. Yeah, we do not enter on the exit candle, yeah, because the price move mostly has exhausted itself, so we don't want to run after a trade. We ignore additional signals on the way, be they in the same direction or opposite, and we do not trade the third signal in a row when the two priors were not confirmed. Yeah, so we have this, yeah, when is a signal confirmed? When the next candle ticks a tick higher. Yeah, the next candle needs to take a tick higher out, and then we'll trade. Yeah, so when we didn't trade in that because we want a day trade, no trade after 15:30. Okay, and we neglect the signal at 1800 at 6 p.m. East. All my times here Eastern time. Yeah, we don't do this, and we operate with bracket orders. Yeah, here we don't repair. We do buy stop, sell stop orders, OCO. So the bracket one cancels the other, means either your target closes the entire trade or you stop. Yeah, so that's easy trade management for you. And we trade for 20 ticks. So what does it mean? We let the program draw a bar by the specific instrument that we're looking at. And our first example will be the E-mini S&P 500 index, and we're going to trade it for 20 ticks, and we add up the good and the bad trades. Yeah, and I took 10 trading dates backwards from August 22 that are drafted out in here. Yeah, so we enter one tick above the threshold that you will see on the chart, and we exit then after 19 ticks. Yeah, so when the trade for 20 ticks minus 1 tick, which ticks it in, so it's 19 ticks is your reward. On the other hand, we consider 2 tick below you stop. Yeah, so that's 22 ticks you lose when you lose, and you have a commission, and the stop goes below the entry candle, and you have a commission of $5. Yeah, so those are the mathematical backgrounds, and we can do our break even. You see, we take the slippage, we take the commission, and we take a break-even point with that formula that we saw before. And so the system has to deliver a minimum of 54% accuracy to bring us over the hump or bring us at break-even. Yeah, so then we make 0. If we are above that, we have a good edge and probability to move forward and make money from now on into the future. Yeah, so here's how the chart looks like. Yeah, and I highlight a couple of situations. I highlight the good ones first, and then I also highlight the bad ones with you. But let us look here. So you have here a threshold. It says sell the E-mini S&P at 2,464.30. That's 25 because I let the system round up. And so the next candle, when it ticks one tick below this, yeah, that would be even, 24.64 even. Then it has a trade, and you'll take out your trade 19 ticks below your entry. That's here at the point. Bang, at that candle you take out. So wonderful, we'll take it. Next candle wasn't the exit candle, so we have another one of those trades, and bang, it's home. Yeah, next candle, yeah, and that's home. You see here, when it takes it to that tick, and it's very easy to put it up there, then it's home. And this one came home. Here's the one that didn't come home, and this here's one that we didn't take, and I show you why. Yeah, so first one was a winner, second one was a winner, yeah, third one was a winner, this was a loss. Yeah, we assumed it's going to roll down. There it ticked it in by one tick, and then it was so unfair to take us out. But look, it's high probability trading. We won 3 in a row, then we lost number 4. Then we won number 5, and we didn't trade this one. Why? It was after 3:30, after 15:30 East or 3:30 East, we don't trade. And so therefore we concluded that day, what was the balance? Yeah, so we had 4 winning trades with 19 ticks times $12.50. That's the value of a tick of that future. It's $950 of income. And then we had one loser, 22 ticks, 275, and bang, we made $675 of a balance. And what did we need in our pocket for that? Depending on your broker, many give you that trading opportunity for a $500 margin. And so that's pretty good. When you ask for the full margin, maintenance margin, about $4,600 right now, but you don't take the trade overnight. So no worries about taking the maintenance margin. It's just the decision of which broker you work with. And so that's real life here. It was August 9-10, 2017, and I drafted forward till August 22 all the trades, yeah, every single one, to share it with you and see how does it work out. So you see, not every day is a winner, yeah. So bang bang, there were 2 losers. Okay, was it terrible? No, losing is part of the game. So we sucked in some wind, and on the second day made a loss. On the third day, yeah, time was beautiful for us again because we made up what we lost before, and we moved ahead. And so you see here again, clear-cut buy threshold, yeah, came to target out. Buy threshold, yeah, came to target out. This one came out here. This one can come here. No trade after 3:30. Yeah, clearly rule-based, and you wouldn't take the 1800 candle. Yeah, so this is how we go, step by step, trade by trade, and we'll look through it. I don't explain each and every one of those, but you see again, look here, clear buy winner. This one, why was it a loser? So, and how much did it lose? So look at this one. It got ticked in, but it didn't make a move for 20 ticks. So it's obvious. So it came back, it didn't take the stop, yeah. But here at bar number 3, it didn't even take the stop out, but it closed then here. So we lost a little less than our supposed 20 ticks, but anyhow, we'll took a balance of negative. But then again, winning trades, yeah, bang, 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 yeah, and no entry at the exit candle, but here you have another winner. So what I did is I added all those up, and here you made 4 times 19 ticks, the winners, and this is a 950-day winning day, yeah. And so the next day was a mixed bag, August 17, 18. Yeah, so you saw we had some winners, we had some losers, and didn't make a positive balance. And then we have August 20 to 22. I put them all here on a chart. Yes, so looking here, got a winner, got another winner. So it's a very positive 2 days. And so another time we made 950, how we strike a balance together. Yeah. In that balance, you see here the individual trading days. you see how many winners and how many losers we had, and that's nice. Okay, we wanted to be above 65%. We are at 68% winners, 17 out of 25 trades. What was the minimum threshold to trade the system on? 20 trades. So we'll held ourselves accountable for the same. Yeah, and so 32% were losers. So in money, we gained 3,950. However, we also had to suffer under a couple of little losses. But the cool thing is, look, the winners are bigger than the losers. That's also big. Yeah. So you see the winning trades, and we have more winning days than losing days, or more winners than losers. And then we surely pay the commission. Yeah. So we took the $5 round trip cost and applied them to the amount of trades that were there. And then we produced a total gain of $1,735 in the observed time frames of basically 10 trading days. And what does it mean? At a day margin of $500, if you put that in or had it in your account, this is a potential 347% return in 10 days. So that's doable following a system, but whatever you do it with us or with what you learn. Follow a clear-cut system, clear-cut rules. And you see, I went fast on the rules, yeah, but we always teach them one-on-one with everybody, not just on a video, because every system needs to be harmonized from whomever it is to your individual risk tolerance. That's a big word, but everybody has a different risk tolerance. The risk tolerance should be in balance to your total account holdings. That's important. Take a note on that. And when you listen to me, it should be a max of 2% of what you have in your account at the beginning till you learn. And when you know what you're doing per trade, should no more be more than 5% risk of what you have in your account. That has to fit together. If you violate those rules, then it's going to be very, very hard to trade. But so take a note, 2% should be your max risk at the beginning until you know what you're doing, until you are certain that your system is delivering. And when you know what to do, the maximum is 5% per trade. But also I'll teach dynamic trading depending on the trade setup, the risk and reward. Then we'll balance what we put in, and we only want to trade with the odds in our favor. Yeah. So as I showed, when you have a relation, which you can't have here, because every bar was 20 ticks wide. Yeah. This is what we let the system make. 20 ticks, bang. 20 ticks. So it was not a relation where you could say, look, how I only trade for a little and here and there and change something. No, the plan has to be laid out clear and cut clear for you so that it gives you the indication of where to go in, where to go out. So you saw and you knew from the beginning, I'm making 19 ticks when the thing works for me. I lose 22 ticks when I get stopped. But with the probability of my system, I have a high probability to come out with a positive return after that, but also will teach you at certain point in times how things roll up and how they roll down, and how you can specify where there is a higher probable trade and where there is a lower probable trade. To put that all into this presentation would be a little bit of a lot. Yeah. So let's look at other assets. Yeah, so does it only work for the S&P 500? So I just took some random days. What you see here, crude oil. Every bar is again 20 ticks wide. Yeah, and you might say, wow, this bar is shorter than 20 ticks. Yeah, because it's at the closing of the day, time-based it was cut off, but then it continues on, and on crude oil we trade over. Yeah, so we trade on crude oil in average for 4 bars. So you see there's a little bit of difference between the one future over the other, but crude oil has the tendency to always come back a little and then make it. Yeah, so you see here trade number 1, and let me take a pen from those drawing tools. Yeah, so trade number 1, there was your target. So that was bar number 1, that was your entry. Bar number 2, bar number 3. Yes, you have to go out. No. Crude oil, we trade for 4 bars. Bar number 4, you're out. 4 bar, no question, out. Yeah. Okay, that worked. Yeah. So crude oil trade number 2, I wrote them in. There was your target. Bar number 1, crude oil came a little back. That's the nature of that piece. Bar number 3, bar number 4, bang, hit. Yes, you see the low is lower than this, so you're out. Yeah. And so then again, let's look at this. Yeah. Entry, yeah, because 1 tick below, it's very easy to set the target, and choop, in that candle you go out. Yeah, so then reversal in here, entry above that threshold, fulfilled, any overnight session. Yeah, that's a cool thing. Crude oil is also good tradable at any point in time of the day. And so you saw here, so there on the second we bet on a good trade. However, it was a loss. We got ticked in. We never get to target, but we get to stop. Yeah, and so that trade where we get stopped usually is not a trade we'll take. You learned that at the rules. Yeah, so that would be an open trade, but we wouldn't have done that. But let's count the good and the bad trades in this one here. So let's take the good trades here. So you had here, you had a winner, 2 winners, 3 winners, 4 winners, 5 winners, 1 loser. Yep, that's pretty much high probability trading. Yeah, so I'll have to get back here and then go back and take all of that out. So I hope I don't carry now forward the all of my drawings. So here we'll have to get in and delete the drawings, erase all drawings. I'll have that ability. So what you see here is the Australian dollar as a future. Yeah, so we do the same thing. Yeah, let me take my drawing tool again, the pen. Yeah, so we have the same thing. So here, a tick in, every bar is 20 ticks wide. And you do the same thing, 19 for winner, 22 for loser. So the tick range here comes to target after 3 bars. In this one, only crude goes for 4, bang, home. Yeah, so then you have the repetitive pattern, and that's important for a system, repetitive pattern, bang, came home. Yeah, so next trade on the horizon, yep, and did come home, absolutely. 1 tick later you got in. And the cool thing is if you trade like this, if you have a price threshold and you get ticked in, you can work with a buy stop. So how do you do that? You go on a dome and you put your target 1 tick above the threshold, which is in there. When it gets ticked in, it takes you in with the bracket order, then you stop and everything is on there. And you have very little adjustment because you take a 22 tick stop and a 19 tick exit, and you do that on a point and click right in it. Yeah, and so then you see that again, we'll worked here and came home. Yeah, and we'll do that here and the trade came home. So it's repetitive on the short side as well. So then the thing fell over, had its first signal coming here, and then after coming to target. Yeah, and at the target bar, what you do, you don't trade. Okay, so see, I show clear-cut rule-based trading with you. Yeah, so this was your target bar. Yeah, there you got out of the trade, and when you get out of the trade, you don't enter. Yeah, so this is, and when you have continuation patterns like here, so you had a trade, there was your target, and you get another confirmed signal. So we don't double up. The first target stays in. We are happy that we have a confirmed signal. At that point, we take it out. And there's a certain pattern that we follow because you know prices like to go in a certain pattern to the up and the downside. But here on our example, we took everything mechanic. Yeah, taking all the trades as they came along, and let's cut the good ones and the bad ones. Yeah, this one was definitely a winner. This one was a winner. This one was a winner, number 3. So was this number 4, and that's 1 trading day. Yes, you see here, that is the span of a trading day. So the Aussie dollar gave us 4 trades, all home runs. Yeah, so then here when you took this one, the 1800, what do? We don't trade them. Yeah, so again, as we had it in our rule, only crude oil we do this. And so then 1, 2, 3. Yeah, so the next day you had another winner. Did we take this? No need for it because we were in the trade already to target. And then on a second instance, we got ticked in here and we got out here. And exit bar, no entry. Yeah, so this is all rule-based trading. So but what did we achieve? So 1 winner and we had another winner. Yeah, so one day 4 trades, all winners. Next day, 2 trades, all winners. Again, high probability trading. And I did the same and translated it into the Aussie dollar as a pair, looking at the same time-based increment with you. And it looks as follows. Yeah, so it looks as follows here. No trade on the 1800. And then this one, you see, translated, came home. Then you have that trade here as a winner. How far? 1, 2, 3. So bar number 3, let me do the drawings with you, then I can make it more visible. Yeah, so that was your first target. here on the chart. That was your second target here on the chart on bar 3. Then we did have this one as a target. Yeah, so you see it translates regardless of the instrument you are looking for, always with the same imperative: high probability setup, clear trigger by the system, entry, exit, positive exit, stop. Yeah, so all of that works together in one conjunction and helps you to set up your trades at any point, multiple times throughout the day, because this is clear cut for day traders. Yeah, that's what we made for day traders. We work with swing traders and long-term investors, but this is not part of this presentation. We work a lot with options and stocks and others, but here we want to really concentrate first on futures, partially also on Forex, giving you an idea of how you can do systematic trading as mechanical as possible and in a repetitive way and manner. Yeah, so what you learned, again, system shall have high predictability. Take 20 instances, I showed you many here, to do it. Intelligently put reward and risk in balance, because if you take too tight stops, you're stopped all the time. But also when it is too hard to trade, yeah, 2 times the risk to 1 time the reward, then don't do it. And therefore, we translated in our system everything in a constant bar. Yeah, range bars of 20 ticks is what we trade for. Why 20 ticks? You saw at the beginning we use these minimum attainment of $150 to $250 to be meaningful. And so with that, we took an average and said, okay, most of the $10 per tick lineups gonna relate to that in a way so that we can trade for $200. In the S&P 500 example, the E-mini, we showed you trades for $250 targets minus 1 tick. Yeah? And so that all shall help you to find what suits you. Yeah, that's important, because basically what we say, you need an edge in trading, and you need to be prepared for having an edge, yeah, by determining how can you repeatedly do that. If your time allows for day trading is a wonderful thing, because it offers you multiple opportunities a day, and you can lose leverage by either trading Forex or futures. They're great leverage products, but always consider to gauge your risk. Yeah, keep it at a meaningful minimum. Yeah. And so what we showed you here is called never loss trading trend catching. Yeah, so it tells you something. It wants to catch the trend, however, in multiple increments along the trends, because we don't believe that you can specify a very long range. So we rather take multiple trades, and we can prove financially that it makes more return than trying to hit a home run all at once within not having all the bases set. Yeah, so here, here is the example. Yeah, so clear-cut rules. Yeah, I took here a stock. Yeah, again, entry, exit. Entry, exit, rules, rules, rules. This is how we operate and work it. And we teach, because everybody wants something different, everybody has a different risk tolerance, we teach one-on-one. If you just could read a book or watch a video and can be a trader, that's as easy as you say, I watch a video and then I can fly an airplane. It needs practice, work, sharing, working together to help you to see the same that we see. As simple as it looked here on the chart, it has to be translated into means on your side. And so therefore we decided from very early on, and we in business since 2008, to do one-on-one trading. Yeah, because then we can work with you at your best available times. Often we work with people who have a job early morning before they started. We work together, look through the market, work how the things are going, and map out a clear-cut strategy and a business plan. That's also an encouragement. Have a written plan of what you want to do out there. So what do I want to trade? How do I want to trade? How do I prepare it? Which signals do I take? When am I out of the market? It has to suit you. Yeah, don't overtrade. If you want to trade 18 times a day, it's not going to work. Yeah, because the market doesn't give that many meaningful moves. Yeah, you saw it, how I mapped it out with these $200 moves. And so that business plan for trading success shall contain a financial plan. What shall you expect with the probabilities that I showed you? Risk to reward in relation. So what shall be after so many trades in the time that allows you? and do that on clear-cut entries, exits, stop, or later on, if you learn it, then on adjustment level. So instead of taking the stop, you adjust the trade, and with that you minimize what you can lose, or you even turn a loser into a winner. Yeah, so this is all essential. Yeah, so I hope I'm able to give you here key corner points of what a system shall do. So key is also to not trade for real low amounts of price moves. Yeah, the same for stocks. Yeah, if you trade for nothing, then your trading cost and your slippage will eat everything off. Yeah, look for repetitive patterns. So you saw we saw the same thing happening in the ES. I had a Goldman Sachs chart on it. On the stock, we had the Aussie dollar we jointly looked at. We looked at crude oil. So you had repetitive patterns because you know price moves are always triggered by institutional money mostly, and we can be part of it by finding it with the system that gives you high probability entries, exits, and stops. Yeah, and it's interaction based. So when something happens, you want to be in. When nothing happens, you want to be out. And you have replicating markets. Yeah, if you would like to take, if one time I had a trader only wanted to trade random length lumber. Yeah, so he said, wow, what's that? It's a future. And he had a reason for it. He had a reason for it because he was selling Home Depot nationwide and he wanted to hedge his account. Yeah, so therefore we showed him a system to do that with him and for him, but you don't want to be in his class because, you know, do we trade random length lumber daily? No, absolutely not. It has not the volumes that we want. It doesn't have the activity, but for him it was important. But this is why we do individual training. We look what suits you and then tune everything to your wants and needs. And that's also what I liked you to ask everybody whom you learn from if that can be fulfilled. Yeah, and so with that, one size doesn't fit it all. You will tailor everything to you and you deserve it. Yeah, in a financial and an action plan. And this is somewhere take a note what you want from us or from whomever you want to work with in learning how to trade the markets. And it's important to specify your entries, exit stops, follow repetitive patterns, trade multi-assets. That's also good because, you know, sometimes the ES doesn't move. So if you can't trade crude oil at the same point in time, you have no way of making income. But we show this, have high productivity. So 2 to 4 trades, 3 trades a day, and one-on-one learning so that it stays and goes with me. With you. And so here I want to make you a special offer. So the trend catching that you saw today here, or our basic system, trade colors, that's called. I wasn't doing any reference to that today, but when you want to start with that, that's our actual price. So but we want to give you something off. Yeah, so here today our special offer for learning that system one-on-one, and we added 2 more training hours that will be a high value for you, because we usually calculate the hour with $400. And so therefore, that's our price here is $6,500 straight with no tax for it, or also for our basic introduction system, $2,400 without tax. That's not available online, so you'll have to write us to get that special offer. And we also added another hour of training. Trust me, the training hours will be prepared, filled with excitement and filled with knowledge. That's the most important. And everything will be recorded for you so that you can go through the learned again until it sits. Yeah. So what does a mentorship all include? It has server installed software, real-time data, always entry exit stop in it, position sizing models we work on, yeah, because, you know, when it's lower probable for you to take the trade home, then we take a smaller size. When it's more probable, a bigger size. We specify the time in the trade. You saw these 3 and 4 bars that we did together, and we do risk handling. Yeah, so how do you handle the risk situation? And a business plan, written plan, will help you to fill out so that you know what to do when you go to the markets. Again, that's our special offer. We offer only to the participants of this meeting, yeah, deducting the price. We do very little in price because we are really often filled by recommendations, because we helped a lot of people over those years that we are in business, coming up to 10 now. And with that, we invite you, if you want to stay with us on the basis of our free trading tips, reports, and webinars, sign up at our site. Or if you want to have a personal introduction to what we do here, or also want to challenge us, you can call the individual symbols and we show you the good trades and the bad trades. and you can call us at the office 866-455-4520 or contact at neverlosstrading.com, and we are happy to set up a specific time, but also only do this if you're really interested, because you know time is of essence and of value. If you are interested in it, we'd be happy to entertain you, and there's no, it's free. Yeah, it's free. We'll sit together with you one-on-one, go through different trade situations. Yes, at the end we ask you if you want to be part of our group of never lost traders, but there is no obligation to it. Yeah, so that's our offer here to you. Yeah, so you saw the systems are always taught individually, and at that point in time, again, if you have questions, we have another 1 or 2 minutes because I timed it well today. And again, I want to thank the organizers, and also I look forward to the other presenters. I hope I was able to make it exciting. Yeah, so take the opportunity, call us 866-455-4520 or contact at neverlosstrading.com and sign up for free trading tips, reports, and webinars. It's right on the website www.neverlosstrading.com. At that point in time, again, thank you very much for your attention. We're looking forward to hearing back from you.